Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Welcome back to the Risk Intel podcast. Cathy, it's wonderful to have you back on the show. As a reminder for our listeners, you bring a unique perspective to this conversation, right? Having worked as a chief operating officer, a CRO, and several other roles inside financial institutions, and now you solve risk problems from the outside in as a partner to financial institutions, leading the implementation of Watchtower, the holistic risk intelligence platform. Cathy, welcome back.
I'm happy to continue the conversation.
Terrific. As a reminder, right, you say continue there, right? This is a continuation. This episode is the second in a series of conversations around best practices to evolve an existing ERM program or build a new one to operate in this new world of risk-informed strategic decision-making, a world in which financial institutions, we are seeing them shift from using outdated quarterly call report content to check the regulatory compliance box, so to speak, towards one in which institutions incorporate monthly risk data and more timely data into strategic decision making. Last time, Cathy, we discussed the value of a core set of standardized key risk indicators. Today, we're going to build on that, and we're going to tackle the topics of data timeliness and data frequency. So let's start by looking back at how we arrived in the current state, and take us back to the way risk was measured when you arrived in the industry as a bit of a foundation for this discussion.
Absolutely. Years ago, to say it was informal would be generous. I think it was intuitive. I think it was experienced based, not based on any evidence. It was experienced based for sure.
Yep.
And then that next step in the evolution was certainly to go to a more methodical, defined, qualitative assessment approach. Was very reactive, historically based, and definitely truly a hindsight perspective.
All right, so that's if that's our baseline, if you will, right? Let's roll the clock forward a little bit. How has the frequency and the timeliness of data collection and evaluation evolved? What have you seen in recent years?
Well, definitely that move toward reporting with that regulatory cadence. Everybody reports, call reports, they do 10Ks. There's that regulatory cadence. One of the advantages to that regulatory cadence, of course, was the opportunity to get measurements against your peers, right? And so that was the advantage, and that was the gold standard. You had a little bit of a peek into what other people were doing, and kind of gave you an opportunity to measure yourself, good, bad, or indifferent. And also with that regulatory cadence, you usually take a more broad look at information, right? Quarterly in general, when there's a quarterly meeting, you present more information. And of course, everyone did that annual look back. And so that was kind of the way it was done before, very, as we talk about call report driven information. And so that's kind of where it evolved to next.
All right. So I think that's right. Feels like a natural progression, right? And the the more broad, the look at a more broader set of data, getting a peek into your peers, right? Because those call reports, right, are available, right, in the public domain there, and maybe taking an annual look back, right? That's all well and good. It is progress, but how does that hold up, right, in the current environment that we're operating in, right? I think we've seen a bit of progress even from that set of dynamics to where we are today, and even where you're seeing things starting to push now going forward.
Absolutely. Today, we might suffer from a little bit of information overload, right? It's coming from everywhere all the time. It's daily, it's monthly, it's weekly that you get information. It's coming from all kinds of sources. You get information from your core, from your general ledger, from specialized reports that have been written, by people in the institution. You've got all your ancillary systems. You've got fraud systems. You've got BSA systems. You've got ALCO systems. And so you have this information overload. But what tends to happen there is people are monitoring, but they're monitoring in silos, right? I'm looking at my piece, this person is looking at their piece. And so there's a need to bring that together. Again, the data is here, it is timely, it's actionable, but you've got to bring it together to make it make sense in that risk lens. And so we're blessed with more data available frequently, but we're monitoring that in silos, which is kind of where the risk and bringing together that core set brings that picture together.
So that's I think there's a couple of different themes I'd love to just maybe dig into a little bit there. The first is the fact that I think information overload is a great term to use, right? There is a lot of data and it is arriving all the time, and so that I think highlights the fact that in that secondary state you mentioned, where perhaps the call report was seen as, whether you want to call it the gold standard, or at least the largest source, if not the only source, right, of data that went into a quantitative risk evaluation. And that came in, on schedule, right, once a quarter. You knew it was coming, and you marshaled resources and you attacked it at that point in time. Now data is coming in continuously. And so that's a very different dynamic to be able to build your risk program around that, build your team around that, and be able to manage that continuous inflow, if you will, of data. That's a very different dynamic of kind of once and scheduled to it's coming in kind of fast and furious from all directions.
Right. Which is like we've talked about, you condense it, you gather it, you distill it, you condense it down and allow people to focus, on what's important, what's truly actionable, what's truly informing the risk there at the bank, what can move the needle, what's aligning with our strategic plan. And so again, it's great. You've got it. It's timely. Now take it and use it. And view it through that risk lens, in addition to all of the other lenses you're using to view that data, right?
So I know that right, we've seen situations where there is a monthly operating committee meeting, or maybe even a monthly enterprise risk committee meeting at the board level. So, right, are you seeing people trying to, even though that data is coming in on a continuous basis, to try and distill it down, let's say on a monthly basis, so it's more frequent than that quarterly cadence, and the data is coming in on a more timely manner because it's coming in continuously, but it's consumed, it's packaged together on a monthly basis. Is that a practice that you're seeing?
Yeah, it's absolutely a practice that I'm seeing, and I probably started to see that maybe a year or so ago. Most interesting was one bank who actually deviated from that quarterly run of their ALCO reports. And they were running them more frequently because the board was saying, by the time we see this, it's old, and that bank adapted. And so I'm like, wow, that makes sense. And more and more. Again, as you educate board members, they're reading the newspaper, they understand risk. They're asking for it. And so definitely banks are moving in that direction.
Right. The speed with which external factors, right, can impact an institution mean that if you're operating with data that is quarterly and right versus monthly, and then if the quarterly data is coming from a call report, right, which is not filed on the last day of the quarter, right, there is a significant lag period there. You're operating with data that is quite stale, whereas the market, as we've seen with instances where there have been runs on deposits and so forth, right? The market is moving a lot faster than that. They're not going to wait around for that quarterly backward-looking data to arrive.
Absolutely. And who wants to be asked by a board member or worse, an examiner, about what's happening currently, and you pull something out, that's from last quarter. And so, yeah, talk about no.
Um, the concept then of more timely data is one aspect, and more frequent is another. We talked a little bit about frequency. The timeliness of the data is an interesting concept there as well. You talked about an example where a bank asked to really increase the frequency of those ALCO reports so that you get a more timely view, not just a more frequent view. You're looking at that, let's say, in the first kind of 5, 10, 15 days of the month there as well, right? That's the other dynamic of timeliness.
Absolutely. And of course, that became critically important as rates started to move and as depositors started to exit. That information was certainly needed quicker. And so that bank responded.
Would you say how are banks who are thinking about going down this path? How are they thinking about moving from quarterly kind of call report data towards, let's say, monthly data? And that's a shift in culture and mindset within the bank. There's also a practical kind of logistical aspect of how do you do that? Is there anything you could share in terms of your view of what you've seen and how banks should be approaching this paradigm shift or this methodology shift?
Absolutely. It really is about distilling that data. Again, you're getting so much, but getting the focus on what needs to be known quicker, what needs to be known quicker. Again, the interest rate risk reports is a great example of what needed to be known more quickly. So you start there. What has the bank called out as far as loan growth? Are we meeting that? Are we meeting that in the ways that we thought we would? Sure, loans are growing, but are they growing where we wanted them to grow to meet our profitability goals? So it used to be, yay, loans are up. But is that a reason to yay when you're looking at how we want it to grow? And is it going to move that profitability needle? Same thing with deposits. We're getting in all these deposits, but are we paying an arm and a leg, and are they short term? And so it's distilling it down to what's important. Let me look at what's important more frequently, and I need to know that in a more timely manner. So that's how you move that information, right? You know what's important. That's step A. And then you bring in information that informs that.
All right, you've talked a bit about the how there. Maybe one final question here around the why, or really what is driving this trend towards more timely data. We talked a little bit about it there, around the speed with which things move in the market, but other drivers behind this trend that you see?
Oh, absolutely. It's sort of like preventive care. The earlier the more time you have to address it. So getting that information earlier, patterns and trends are going to show up quicker, like we talked about last time. And that's going to help you identify whether or not what you thought is happening. You're able to kind of demonstrate that you can not just understand and grasp the risk that's present, but risks that might be playing out in a different way than the way you thought they were going to play out, and being able to pivot to address those things as they're happening earlier. So when you're talking with not only regulators, but your management team and your enterprise risk committees, you're able to, again, show that agility, show that insight. To be effective these days, you have to look ahead. You got to look down the road, but now you got to look around the corner. You can't just look down the road, you got to look around the corner, right? So that risk process that we have today has to move beyond hindsight. Hindsight's kind of over. You got to continue to be insight-based because you got to understand it. but it's got to move to foresight. It absolutely has to move to foresight, exactly what you said, the market, the technology, consumers and investors, right? All of those people are getting that information at the speed of light. And you have got to be able to no longer react. You have got to be proactive.
Get on your front foot. I think that a number of the descriptors that you use there, Cathy, I think really resonate. And we had a conversation with a risk officer recently who said, it's really helpful to be able to turn risk speak into plain English. And I think that's right. Some of the vernacular you use there really are some great comparative descriptors there, right? It's like preventative care, right? Get into it early. You have more time then to address it, and it allows a pivot. And you're not just looking down the road, but you're looking around the corner as well. And I think that those concepts are really powerful, and they reinforce, I'll say, the more risk-oriented terminology of moving from hindsight to insight to foresight. You've got some great concepts there for people to I think consider and contemplate, and hopefully start thinking a bit more about more timely data, looking at it more frequently, and then if you put that on top of the concept we discussed the last time of a core set of standardized KRIs, that might be an easier way to get out of the gate as well, right? Instead of boiling the ocean, right? Maybe ultimately you want to get to 100, 150 KRIs that are important for your business. Start with those essential 44, right? Start with that. And I know in your methodology, 40 or so of those you can get from a core or a GL, data extract, right? So you can get that on a monthly basis. You can pull that in a timely manner, and you can get that insight and start to get to that foresight it gets you out of the starting gate, right? It gets you moving down this path.
Absolutely. Absolutely.
Well, Cathy, thank you. I appreciate you taking us on this journey back from the days of intuitive, informal, experience-based risk management to one where, right, we're living through information overload. We're monitoring in silos, but now the next challenge is to bring it together. And to really think about this with that preventative care methodology where you get ahead of issues, you see them earlier, you have more time to address them, and you start looking then down the road and around the corner, so you can anticipate and put the bank or the credit union in a position where you address issues before they become big hairy beasts that you can't get your hands around. So thank you for that perspective. We encourage our audience to join us next time where we're going to discuss utilizing a consistent quantitative methodology to benchmark an institution's KRIs, and then intersecting that data with your personalized risk appetite. So standardized KRIs, more timely, more frequently evaluated. And now what do you compare that against? So Cathy, we look forward to continuing the conversation, and thank you very much for your perspectives here today.
Happy to talk to you, Ed.